All right, we got stocks near the lows of the day as we head into the final moments of the session here. We'll see if anyone steps in bold enough to buy this dip. Nate Peterson, Director of Derivatives Analysis at Schwab Center for Financial Research. Nate, the Russell's a sizable dip, more than 2%, but elsewhere, I mean, who knows? Could we close positive still?
Well, Russell's getting hit because the 10-year, basically, like you mentioned, closing near the highs of the day. Our high of the year, the close is 4.325. So we're not far from there. Why is that important? Well, if you break out to a new high for the year, then that kind of tells you that there's price discovery going on within the bond market in terms of what appropriate yield is. I'm using the 10-year as a proxy. But when you're seeing yields go up like this, Oliver, there's like less places to go and hide. Stocks have their own kind of technical issues that are going on right now. Although I will say this, on the semiconductors, we have pulled back to our 23% Fibonacci retracement level around 47.22. We didn't quite get there, but almost today from the peak going back to the October low. But money is coming out of the chips. It's finding its way into stocks like Microsoft, Apple, Alphabet. It's going to energy. You talked about the breakout in oil, but you can't go to biotechs. You can't go to solar. You can't go to real estate. You can't go to utilities. You can't go to small caps when yields are rising like that. And then it's also creating a punishment for those that are going out there and trying to get into those rate-sensitive plays with the expectation that the Fed is going to be, doing X number of cuts. But Oliver, it seems like we continue to resize or reset our expectations around how many rate cuts we're going to get, and it just continues to get pushed out further and further and further. For example, the June rate cut 2 weeks ago, it was 95%. We're now down to 60%. I feel like you get a little bit to a breaking point where you're testing the bullish thesis or the patience of the bulls so much that it feels like we're due for at least, something about a 5% correction, which would not be that big of a deal.
Okay. Yeah, and how far we've run here, as we just heard from Jim Carson, dips should be welcomed. To stay in trend, I think is what the argument would favor. But it does also bring up this conversation about inflation, the fact that outside of the AI earnings-driven boom, which helps those valuations, not look too extreme compared to rates, the broad market does still. And it's like, to your point, there's nowhere to really hide. So if Nvidia stops going up, then we've got some issues here.
Yeah, and on the inflation front, that was kind of built into the bullish thesis coming into the year. Inflation slayed. The Fed's on our side, double-digit EPS growth. This inflation story, last month, they brushed it off. Oh, it's just one data point. That's nothing. They continue to send stocks to fresh all-time highs. Now we got another month that we're getting these data points again that are coming in hotter than expected. So that begins to just build the case that what is going on with inflation here. My guess is that, when the Fed pivoted late last year, they haven't cut, but the bond market did. And those ease in the conditions might have done something to kind of fan the flames just a little bit there. It's probably still too early to say, but the problem is that expectations that the market has around inflation and the Fed, that's being challenged. And then therefore, is that 21 forward PE on the S&P 500 appropriate with all this new information that continues to come in?
Yeah. It really just kind of puts in perspective some of the, breadth arguments where it becomes almost like a Rorschach test where like people are rightly pointing out that breadth has improved. You have more companies making highs. But the thing is that when the market's been down here, there's not a lot of stuff up. Like I looked through my factor list, and it's basically only anti-beta, BTAL, this like anti-beta fund. Like it's only literally fading the stuff. Like there's not a lot else working. So even though the market's broadened out, it's pretty much only broadening out on up days. Today it's basically dollar. That's it. That's the only thing other than like direct shorts on high beta funds.
Right. And so you're right. When we're in those uptrends, we're making new highs and the AI story is intact. the technicals are intact, the dip buyers are getting rewarded, then the money begins to look for alpha in those underloved kind of areas of the market. So it works when you have that outperformance within beta. Now that you have that significant reversal day we had last Friday in Nvidia, along with a couple of other bearish reversal patterns here within technology, then it just gives you less of a place to hide in terms of money flow. Couple that with rates going higher, and yeah, you're getting squeezed a little bit in terms of trying to find a place where money can grow. And so, look, this pullback in the semiconductors, this could be it. It's possible, and we continue our uptrend, and then that can help to bring life into other areas of the market. We got Nvidia's GTC conference. We'll see how that goes, but we just got to take it, we got to take it day by day. I'm a little bit concerned after the GTC conference that we don't have enough of a catalyst to hold the AI story intact between then and when we get Q1 earnings starting, mid-April or so. That's where I'm a little bit concerned after we get past Thursday next week.
Okay, I like that. That's a pretty good one on the calendar here, where every piece of information now seems to be very important to NVIDIA's story. Always like the thoughts. Thank you, Nate Peterson. Appreciate it.